The spring statement turned out to be something of a mini budget. It was given against a tough economic background. Of course, we are experiencing much higher costs of living. That in turn is driving much higher inflation. That in turn is generating much higher interest rates. And overall, we are projecting much, much lower growth. Not a good position to be in. We cover all of that detail and more, I would say, in our Techlink bulletins. But I want to have a look at one particular change that was announced at the end of the budget, the sweetener, as it were, the budget, I'll call it a budget, the spring statement, the sweetener, as it were, which was the proposed reduction in the basic rate of income tax from 20% to 19% in the tax year 2024-25. So that's a forthcoming attraction, so to speak, but what does it mean in relation to financial planning? Well, self-evidently, it means something very obvious, which is the rate will fall from 20 to 19. But what does that do to planning? Well, clearly, if you have expenditure that you can make that qualifies for tax relief, then it will be better to get that relief when the rate is at 20% rather than when it falls to 19%. The point has been made is that there's an element of stealth tax in this in relation to pension contributions, for example, because when the rate drops to 19%, the basic rate relief often given at source will, of course, drop, and that will save money for the government. But returning to my point on personal planning, then if you've got income that will be subject to basic rate of tax and you can defer it, so you have control over that income, then it will be worth deferring it, not massively, but it will be worth deferring it into that next tax year when you get to that point of being close to 2024-25. So deferring it to a time when it will be taxed at 19%. Something that I think is almost certainly not going to happen, and that is a corresponding reduction in the rate of tax applied to dividends that fall within the basic rate. Currently, they're taxed at 7.5%. They will go up to being taxed at 8.75% when that 1.25% increase to dividend taxation kicks in from the 6th of April this year, so not long till that happens. It is highly unlikely, to the point of impossible almost, I mean nothing's impossible, but almost impossible, that that rate is going to drop when the basic rate itself drops in 2024. The other thing to bear in mind is that the rate of tax that is applied to life policyholder funds is anchored to not the corporation tax rate. We've touched on that in earlier bulletins and videos. It's anchored to the basic rate. So the rate of tax suffered by UK life companies on funds that they invest on behalf of policyholders is currently 20%, and it will drop to 19%, and it won't go up to 25% when that corporation tax rate increase kicks in. So what does that mean? Well, it means that in relation to onshore bonds, for example, keep in mind, this is not new, this is just a reminder, keep in mind, dividends are not subject to tax inside the UK Life Fund, and there's no limit on that tax freedom. Okay, so the 19% applies to all non-dividend income and capital gains. And yet we know we've got that rather complicated system of working out how much tax is paid on a capital gain made by a UK life company and over what period it's paid, which sometimes often leads to a discounted effective rate of tax being suffered. But the headline is 19%, and that will drop to that level after the basic rate change kicks in, unless the government decouples life company taxation from personal taxation in 2024, which is no indication at this point, and it is fairly early, I would say, but there's no indication at this point that that's going to happen. So the rate of on life company funds drops to 19%. What does that mean? It means that you get a slightly better tax environment inside an onshore bond than you've got currently. But the corollary to that is, of course, when you come to cash in the bond, then you will get a basic rate credit, which will be 19%, not 20%. So as a higher rate taxpayer, your tax rate on the gain would be 21%. And if you're an additional rate taxpayer, it will be 26%. You get a basic rate credit, of course. There's no tax credit. There's no tax on related to basic rate of tax. If you invest in an international bond, an offshore bond, then of course there's largely no tax at fund level. But when you come to cash the bond in, some of that gain will be the amount that exceeds the personal allowances and your personal savings allowance, etc., will be subject to basic rate first. It will fall within to the extent the gain falls within your basic rate band, it will be subject to basic rate tax. There is no credit on offshore bonds gains. That's not new. That's just what's always been the case, well, for a long, long while. So that basically means that your rate of tax on the chunk of gain that falls within the basic rate threshold will be 19%, not 20%. What does all of that mean in your decision making in relation to onshore bond, offshore bond, or collective investments? It all depends, as it always does, on the facts of each case. We cover those facts in a lot of detail in Techlink, but essentially it's all about taking advice and getting informed advice in order to make the right choices. And making the right choices on that aspect of your investment wrapper choice can lead to real value delivered in the form of tax alpha.